Howdy, Jacob here. Today we're looking at Monolithic Power Systems in the semiconductor and equipment industry. Just over 32 billion market cap on just under 32 billion enterprise value. Incorporated in 1997 with end customers kind of pretty much globally. Pretty hefty valuation right now, 76 PE, but return on invested capital looks pretty significant, low 20%, which is great. Operating margin has expanded incredibly at 26% currently. Gross margin up a little bit as well with revenue, 600%, whatever that is, a very hefty amount over the last 10 years. So very impressive figures. Balance sheet shows about a 1.1 billion in liquid assets from cash equivalents and short-term investments and 384 million in total liabilities. So from a balance sheet perspective, very safe company, no concern there. On the free cash flow side, definitely a bit of investments. We see that their capital expenditures have grown quite a bit, but in relation to their cash from operations, it's very low. With use of cash being a little bit on the reinvestment side and a big dividend. Actually, they're paying out 0.74% dividend yield, but on a percent wise, that's about 5-year average, maybe 50%. So 50% payout right now. Pretty significant payout ratio for a company that I would think should be reinvesting pretty heavily back in themselves. But again, I don't see the business every day, and I don't see those opportunities. But um, if I were seeing these types of return on invested capital and capabilities of reinvesting at those massive rates, I'd want to be gushing that money right back into itself to inflate these revenue growth and earnings growth as much as I possibly could. So let's start making some assumptions here on the revenue growth side. Last year was a very low growth year actually, but outside of that, extremely intense growth. Maybe I'll put 10%. Let's do 18 on the P and burst of free cash flow. It's a pretty, I mean, they are a pretty big corporation and they've been around for a bit, but um, I just feel like I don't know any moats here. The return on invested capital does help, but again, we're not seeing them invest that much back into themselves in relation to their free cash flow. Let's say 2% share change per year as they're not buying back shares. Maybe let's do 1%. Um, so really, it's just stock-based compensation, pretty heavy. And then net income margins, let's see, 21. Let's go 21 and 22% dividend. They can absolutely afford that dividend, so let's increase it. Um, let's increase it with the revenue growth because I don't want them to be growing fat, or I don't want them to be paying so much out in their free cash flow to where they're not able to reinvest at those immense rates. But again, businesses that make a lot of money sometimes don't have the capability of reinvesting at those immense rates, so they do find a way to give back to their shareholders, which can be a good thing. But just understand every use of free cash flow is part of your money going into that investment. And so if they're giving you money through a dividend and you're earning 10%, um, is that the best thing for the business when they have opportunities to reinvest at 20%? Absolutely not. So there's times where dividends make perfect sense. There's times where it doesn't. But again, large businesses don't always have the capability of reinvesting at immense rates. And so we are seeing a dividend there. And yeah, in our total estimation of earnings and cash flow, we're just getting to a price that's quite a bit expensive. And again, just looking at that PE and how high their earnings are, um, really no surprise there. So I'm just going to be waiting on this one until it gets to a more attractive price. Thank you and have a great rest of your day.